Why is profit on sale not a reconciling item? So, the principle when it comes to reconciling items is that to the extent that we were able to provide deferred tax, we should not expect to see this item appearing in the tax rate recon. So, if you think about our tax rate recon, what are we trying to do? We are trying to explain to the users of the financial statements, okay, why our expected tax, which is going to be our profit before tax multiplied by our tax rate. And let's just assume in this question that it's 30% to make the numbers easy. Why that is different to our actual tax expense, okay, which would be the sum of the current plus the deferred tax. So what we are looking for is items that have been included in either the starting point or the end point, but don't appear in, conversely, the end point or the starting point. So if we think about the profit on sale, let's just put some numbers to this question. So let's imagine that at the end of a reporting year, we have a carrying amount for an asset, and that carrying amount is 50. At that point, the tax base is null because it had completely been fully written off, and so there arises a taxable temporary difference of 50. If we assume that the tax rate is 30%, then we would have calculated a deferred tax liability for that asset of 15. Now let's fast forward to the first day of the next financial year when this asset is sold. So let's imagine that the asset is sold for 70. Okay. So from a current tax perspective, what's going to happen? If we look at our current tax, we are going to have our proceeds, right, which is 70, included in our gross income because it is a recoupment of our prior allowances. There is no tax base to subtract in this case because it's null. So that entire 70 is going to be subjected to the tax. And at 30%, that is going to give us a current tax of 1. So if we just think of these numbers in terms of the tax rate recon, right? In my starting point, in my profit, I have a profit already included there of 20, right? And then in my expectation, I'm taking that 20, multiplying it by 30%. So that gives me an expected tax of 6 as it relates to the profit on sale. But let's think about the end point, which is the actual tax expense. Within the current tax, I have 21, which is the current tax that I have paid on this asset. But does that mean that now we're going to have a reconciling difference before the difference between the 21 and the 6? Well, there is one thing that we're forgetting, and that is the deferred tax. In the prior year, we would have recognized a liability of 15, and now that we have sold that item, the related deferred tax must be de-recognized. So we would reverse that liability, and that is going to impact our deferred tax. So the net effect then between current and deferred tax is 6. And how will you have it? It is the same as our expectation. So that explains to us why profit before tax is not going to be considered a reconciling item on the tax rate recon. Remember the principle. To the extent that we were able to provide for deferred tax successfully, we are not going to have a reconciling item on our tax rate recon because the purpose of deferred tax is to bring our actual tax expense in line with our expectation. Thanks for watching, and I'll see you next time.